Everybody is talking about the real estate market right now. Is it going to crash? Are interest rates going to destroy the housing market? Are we in a housing market correction? Has the real estate market peaked? Well, these headlines are made to terrify, not to clarify. But these are also some of the hottest topics in real estate right now. As a luxury property specialist and realtor here in Naples, Southwest Florida, I'm going to walk you through some of those hot topics so that you have some clarity, hopefully, and are up to date on the latest information. As you have most likely heard, there is a bit of a shift taking place in the market right now. And if we look at the first 6 months of the year, the housing market has been defined by mortgage rates rising. There's an old saying, you've probably heard this before, when rates rise, they take the elevator, and when they drop, they take the stairs. So let's take a look at the weekly monitor from Freddie Mac. So the average 30-year fixed was about 5.09% in this country. Sam Khater, the chief economist, said the mortgage rates continue to inch downward this week, but they're still significantly higher than last year, as we know, affecting affordability and purchase demand. Now, heading into the summer, the potential home buyer pool has shrunk and supply is on the rise, and the housing market is normalizing. So this is welcome news following unprecedented market tightness over the last couple of years. So he also clipped in here back in May 19th, where he said, "Economics uncertainty is causing mortgage rate volatility," end quote. And I think that that's really been the story up until now. There's a lot of economic uncertainty, a lot of things like inflation, instability in the world, what's the Fed doing? All of these things are happening and they're causing mortgage rate volatility. One thing to note here is that you're also seeing this happen in this market as well as across the country. Adjustable rate mortgages are coming to the forefront. So there's very favorable pricing on a 5-year ARM. It's a good product for those who are looking to buy, knowing that they can refinance down the road. Now, back in the housing crisis, adjustable rate mortgages got a really bad name. Now, keep in mind, it's not a bad product, maybe just a bit misused at times. But currently, there's still good pricing out there on adjustable rate mortgages. So that's a great option for some buyers. So let's take a look at the rate environment. So going all the way back to the beginning of the year, and this is going back to December 30th, 2021. We wrapped up the year with a 3.1% for the average 30-year fixed. And we've seen sort of a quick and dramatic rise in interest rates over the first several months of the year. And we started to clearly plateau sometime around like the third week of April. And then in the past several weeks since, we've kind of moved horizontally as opposed to up. That's a good thing. We don't want to continue to see mortgage rates going higher as it eats into affordability and it really eats into the purchasing power that consumers have when they are ready to buy a home. So we can clearly see this plateauing trend in rates. But what we can't say is, have the rates peaked? Unfortunately, my crystal ball is so cloudy, drat. But to bring some perspective to this, here's a graphic to look at. So the average 30-year fixed rate is 5.09%, which is higher than we've been for the last decade, but that's still really low compared to where we were for the previous decades. And that's going all the way back to the 70s, disco balls and all. So the millennial generation is seeing rates that they've never seen before, while many of us remind them that interest rates look like in the 80s and so forth. And keep in mind, people still bought homes during those decades, regardless of those crazy interest rates that we think of now. So this is really, it's about perspective, right? So another thing to consider is that for the last 50 years, the 30-year fixed mortgage has followed the 10-year Treasury Yield. So if you go back in time, looking at this graph, which shows the average spread between the 10-year Treasury Yield and 30-year fixed mortgage rates, it's been about 1.7. So we've all seen the headline, are we in a housing market correction now? The short answer is no. And why is that? Because the technical definition of a correction is any sort of decline of 10% or more in the price of security or asset or a financial market. We're definitely not in a housing correction because experts are forecasting almost a 9% appreciation in residential real estate this year. That's not a correction. So that's a very healthy appreciation. So according to Danielle Hale from Realtor.com, the housing market is at a turning point. So we're at this turning point and we're starting to see signs of a new direction, but the ball is still in the seller's courts in most housing markets. However, In about every market nationally, there are more buyers than there are available homes for sale. So where are we going from here? If you look at demand pre-pandemic, certainly we're going to come off the highs of 2020 and 2021, back to pre-pandemic level demand, which, by the way, 2017, 2018, 2019 were great years in residential real estate in this country. And then on to 2020 and 2021, interest rates dropped, and really the meaning of a home changed across the country. So we saw demand and price increases because of the lack of supply that were unprecedented in the real estate in this country. So where are we headed in demand? Back to pre-pandemic levels, according to experts. So let's look at some existing home sales. So this, as of April, the seasonally adjusted rate, 5.6 million homes. Well, again, here let's look at 2017, 2018, 2019, pre-pandemic years, then 2020 and 2021, and I'm going to go ahead and say again, those were anomaly years. As mentioned before, my crystal ball is still cloudy, but if we look ahead and see what experts are saying about the second half of 2022, it looks kind of like this. Mike Fratantoni, Chief Economist at the Mortgage Bankers Association, he says, mortgage rates are likely to plateau near current levels. We can already see that plateau. Can't tell you if it's a peak, but we're definitely plateauing. His perspective is that they're likely to plateau where they are in the low fives. Quote, the financial markets have attempted to price in the impact of the Fed's action over the cycle, which is what they do, and they're likely to also price in the economic slowdown that will result. Once we are past this rate spike and associated volatility, the Mortgage Bankers Association expects the potential home buyers may be more willing to re-enter the market. So home buyers may in a rising rate environment go, wait a minute. So we've talked about how it has the ability to take people off the fence. Some are going to go one way and say, we're out, we're not going to do it. And some are going to say, wait, we're going in, we're going to get in before it goes any higher. But as rates plateau, this volatility subsides. So they're saying they expect more potential home buyers to be willing to enter the market. And the next point is really regarding why experts don't believe the market is in a bubble or that it will crash directly relative to demand. So the nation is still suffering from a housing shortage that has reached crisis proportions at a time when millennials are reaching the age when they start to consider homeownership. So they're working through the peak home buying years, and we all know that they are the second largest generation behind the baby boomers. So how does all of this data impact Naples and the Southwest Florida housing market? Well, the May 2022 market report by the Naples Area Board of Realtors, which is NABOR, showed that May had the highest number of new listings than any May in the last 3 years. So as we know, 2019 was a great residential year for real estate. So this is a positive data point. And has also effectively doubled since the same time a year ago. So this is going to lead to more options for summer buyers, which is great for our Naples market. But by the end of May, inventory in Naples has nearly doubled since the same time a year ago. But it's best to compare it to 2019, which was a balanced year, and that had 7.3 months supply of inventory. So using that May 2019 comparison, closed sales increased 7% month to month and 18% year to date, which is great. Demand remains strong despite having 3 times fewer options in inventory compared to those 2019 levels. And today, right now, we have 1.9 months of supply. So not surprising, the low supply, high demand are driving price increases in Naples and across the nation. The overall price median in Naples increased 40% from $433,500 a year ago to $608,000. So this is impacted by the lack of supply in that $300,000 and below market, which is down 56% from January. So since January, we've seen a 22% increase in the number of homes sold in the $500,000 to the $1 million price category. And that was also the price range with the strongest sales. So closed sales were down slightly in the high end of the market in May, but this also might be due to the buyer's reluctance to move cash out of the stock market right now. Notwithstanding, cash sales commanded 63.3% of closed sales in May here in the Naples market. Through local brokers and active agents like myself, we're reviewing that report, and we contend that we are seeing so many more opportunities for buyers that are choosing financing for their purchases. If you are considering buying or selling a home this year, there are definitely options available to you in our current market conditions. Thanks for watching today. And if you have questions about the housing market in general, or our fabulous Naples lifestyle in Southwest Florida, or just our incredible communities, reach out, connect with me. My goal is to help you love the way you live, Naples.